Most people think the stock market is a math problem. They believe if they just find the right formula, they'll win. But Benjamin Graham, the father of value investing, knew better. In Chapter 8 of his masterpiece, The Intelligent Investor, a chapter Warren Buffett calls the most important ever written on investing, Graham reveals a profound truth. The market isn't a calculator. It's a person. And more specifically, it's a person with a severe personality disorder. Graham asks you to imagine you own a small stake in a private business. You have a partner, and his name is Mr. Market. Every single day, without fail, Mr. Market shows up at your front door. And he tells you what he thinks your share of the business is worth. The thing is, Mr. Market is manic depressive. Some days he's euphoric. He sees nothing but sunshine and blue skies, so he offers you a ridiculously high price for your share. He's practically jumping for joy, convinced the business is going to the moon. Then there are other days. On these days, he's utterly despondent. He's convinced the world is ending, that the economy is collapsing, and that your business is on the brink of failure. On those days, he offers you a price that is insultingly low, practically weeping as he tells you how worthless your share has become. Now here's the secret, the key that unlocks the entire philosophy. You don't have to listen to him. You have zero obligation to trade with him at all. Mr. Market is your servant, not your master. He is there to provide you with prices, not to tell you what your business is actually worth. You, the intelligent investor, have done your homework. You know the real, underlying value of your business based on its assets and earning power. His daily mood swings are irrelevant to that fact. So, when he shows up acting crazy, offering you a price that makes no sense, you just smile politely and close the door. Don't worry, he'll be back tomorrow with a completely different number. Your job is to ignore his madness and only engage with him when his offer serves your interests. You sell to him only when he is ecstatic and offering you far more than your share is worth. And you buy from him only when he is panicking and offering to sell you his shares for pennies on the dollar. This powerful parable leads us to the most famous quote in all of finance. Graham writes, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." What does that mean? In the short term, days, weeks, even months, stock prices are just a popularity contest. They are driven by votes, which are cast based on emotion. Fear, greed, hype, speculation, what's trending on social media. It's like a high school popularity contest where the most talked about kid wins, regardless of their actual character or substance. A company can be fundamentally solid, but if a wave of fear hits the market, people will vote to sell, and the price will drop. But in the long run, over years and decades, the market acts as a weighing machine. It stops caring about popularity and starts caring about substance. It weighs the actual tangible results of the company, its earnings, its profits, its assets, its cash flow. A truly valuable company will eventually see its worth reflected in its stock price, just as a heavy object will register its true weight on a scale. The noise of the voting machine fades and the reality of the weighing machine takes over. This distinction is crucial. If you are an investor, you care about the weight. You are focused on the long-term value and profitability of the business you are buying a piece of. If you are a speculator, you are just trying to guess who the popular kids will be tomorrow. You're trying to predict the votes, not measure the weight. The intelligent investor understands this difference. They see a sudden drop in a stock price not as a loss, but as an opportunity. It's Mr. Market in one of his depressive fits, offering a discount on the true weight of a great company. They don't panic. They see a sale. This mindset is what separates successful investors from the crowd. The crowd reacts to Mr. Market's every whim. They buy when he's euphoric and prices are high, and they sell when he's despondent and prices are low. They are his puppets. The intelligent investor does the exact opposite. They use their own analysis and judgment to determine value. They remain calm during the chaos because they know that chaos is just Mr. Market having a bad day. They profit from the market's personality disorder rather than becoming a victim of it. So the next time you see the market flashing red and feel that knot of fear in your stomach, remember Mr. Market. Is he offering you a price based on a rational assessment of value, or is he just in a panic? Is the crowd voting based on fear, or is the company's long-term weight actually changing? By learning to distinguish between the voting machine and the weighing machine, you can turn market fluctuations from a source of anxiety into a source of opportunity. Have you ever heard the saying, price is what you pay, value is what you get? It's one of the most powerful ideas in investing, and it comes directly from Benjamin Graham. Let's break this down because it's the key to unlocking true wealth and sleeping soundly at night, no matter what the market is doing. Price is that number you see flashing on your phone screen. It's what Mr. Market, as Graham calls him, is screaming at you every second of the day. 1 minute he's euphoric, the next he's terrified. Value, on the other hand, is the real, tangible cash that the business you own actually generates over time. It's the profits, the assets, the fundamental strength of the company. Think about it this way. Imagine you just bought your dream house for $500,000. You know, it's a great house in a great neighborhood. Now, what if a crazy neighbor started knocking on your door every hour relentlessly? First, he offers you $400,000. An hour later, he's back, offering $600,000. Then $300,000. Would you panic? Would you let his frantic offers dictate how you feel about your home? Of course not. You'd probably ignore him or maybe even call the police. You know the true value of your house isn't determined by his manic mood swings. Yet, in the stock market, this is exactly what we do. We let that crazy neighbor, Mr. Market, live in our pockets and mess with our emotions every single time we check our phones. We see red and we panic, we see green and we get greedy. We've completely confused the frantic yelling of price with the quiet confidence of value. Now let's bring this into the 21st century, because the problem has gotten so much worse. Back in 1949, when Graham was writing, an investor had to wait for the morning newspaper to see Mr. Market's mood. It was a once-a-day event. Today, Mr. Market is right here in your pocket 24/7. He's not just a neighbor anymore. He's a tiny, screaming salesman who never sleeps. He's sending you push notifications. He is using bright red and green flashing lights specifically designed to trigger the dopamine receptors in your brain. That little rush you get when a stock goes up, that jolt of fear when it goes down, that's not investing. That's a biological reaction being exploited for profit. The modern financial system, from slick trading apps to financial news networks, is engineered to turn you from a calm, rational investor into a twitchy, emotional speculator. Why? Because they make money when you trade. Every time you buy or sell out of fear or greed, they get a commission, a spread, a fee. They profit from your activity, not your success. They want you to be that person frantically reacting to the crazy neighbor. Graham's timeless advice, if he were here today, would be simple. Mute the notifications. Turn off the noise. The more you stare at the price, the less you will understand the value. The more you react, the poorer you will become. So this all sounds great in theory, but how do we actually put it into practice? How do we build that mental fortress against Mr. Market's daily attacks? I call it the market fluctuations audit. It's a simple 3-step action plan to see if you're truly an investor or just a speculator in disguise. First, check your horizon. Go look at your portfolio right now. Pick a stock you own. Now, imagine a headline tomorrow morning says that stock has dropped by 33%. What's your gut reaction? Is it a knot in your stomach? An urge to log in and hit the sell button to cut your losses? If the answer is yes, you probably shouldn't own that stock. Your emotional foundation is built on its price, not its value. You are speculating that the price will go up, not investing in the business itself. A true investor in that situation might even be tempted to buy more because the business they believe in just went on sale. Second, let's try the no-quote test. Graham famously said you'd be a better investor if your stocks had no market quotation at all. Let's run with that. Ask yourself this question for every company you own. If the stock market were to close for the next 10 years, and I couldn't sell this stock, would I still be happy owning this piece of the business? This question forces you to think like a true business owner. You're not buying a ticker symbol. You're buying a share of future earnings. If the thought of being locked in for a decade terrifies you, it's a huge red flag that you're focused on the price, not the company. Finally, and this is the most challenging step, you need to reverse your emotions. Our brains are hardwired to do the opposite of what's profitable in investing. We feel good when prices are high and bad when they're low. We need to retrain our brains. When the market is bleeding red and everyone is panicking, you need to see a clearance sale sign. This is your opportunity. These are the moments when great businesses are offered at silly prices by a fearful Mr. Market. Conversely, When the market is hitting all-time highs, when your portfolio looks amazing and everyone on social media is a genius, that's not the time to feel euphoric. That's the time to feel cautious. That's when the crazy neighbor is screaming an absurdly high price at you. Don't let the euphoria trick you into thinking you're a genius. It's just Mr. Market in one of his manic phases. A wise investor in this scenario might be thinking about trimming positions, not adding more. By performing this audit, checking your horizon, taking the no-quote test, and reversing your emotions, you can start to build the discipline Graham talked about. You can transform from a reactive speculator into a proactive investor. You can finally tell that crazy neighbor to get lost and focus on what truly matters: the long-term value of the businesses you own. Thank you so much for watching. If this helped you reframe your thinking about the market, hit that like button and subscribe for more insights on becoming a smarter, calmer investor. See you in the next video. Disclaimer: the following content is based on The Intelligent Investor by Benjamin Graham. This video is provided strictly for educational and informational purposes. It does not constitute professional financial, investment, or legal advice. All investment strategies involve risk of loss. Please consult a certified financial professional or fiduciary before making any investment decisions.